Here's a list of 7 things that you need to seriously think about before rolling over your 401k. Hi everyone, my name is Will Snodgrass. I'm the president of Matt25 Capital. We're a Christian wealth advisory firm located in Texas. And before you start to think about rolling over an employer-sponsored plan like a 401k, 403b, 457, whatever it may be, there's at least 7 things that you need to seriously think about and be aware of just so that you know that you're making the right decision. First thing that you need to be aware of is cost. Now, obviously, there's going to be a cost associated with rolling over a 401k or whatever the plan may be if you roll it over to an advisor. But there might be costs associated if you just go into a self-directed brokerage account as well. But the thing you really need to look at is what are the costs at keeping it where it currently is in the current plan where it's at, versus what is the cost if you were to roll it over or even move it over into a new employer-sponsored plan in the event that you aren't actually retiring yet. So the way that people need to understand about this is that while in most cases, keeping it in the plan is actually going to be the more cost-efficient way of doing it, you have to ensure that that's the case. And the way you do that is by requesting a document from the plan sponsor called a 408B2. This is a plan document that is available to everybody who's a participant. They have to provide it if you ask for it. And what it does is it breaks down all the different expenses associated with the plan and what that means for each individual participant, such as if you're actually paying an annual management fee, what fees are associated with the funds you're in, etc. Once you have a copy of this document, compare it against what the costs are going to be if you roll it over to an advisor or if you roll it over into a brokerage account. Look to see what are the custodian fees, what are the transactional costs, what are the management fees you might be paying. You might be surprised at what the costs are where you're going versus where they currently are. The next thing you need to really think about are, what are my investment options? If you keep your account in the retirement plan, you're going to have obviously whatever their choices are for investment options. Typically, it'll be between 20 and 30. You're going to have some that are what we call target date funds, geared for people retiring by a certain date. And then you're going to have stock options, bond options. Usually they're going to be mutual funds. They might be index funds, but that's really going to be the extent of what your investment options are. Conversely, if you do roll it over, you're going to have a lot more options. Whether you do the self-directed route or you do it with an advisor, your world of investment options really is going to open up. Okay. Another thing to consider is if you want to go the self-directed route, that gives you options that are not traditional. You can invest in things like mineral rights. You can invest in things like real estate. You can invest in commodities. The third option I briefly mentioned is that you can roll your old retirement plan into your new employer's 401k plan or 403b, 457, whatever the case may be. So if you're not retiring, but let's say you just changed employers, another thing you can always consider is rolling the old plan into the new plan. Some people might want to do this for consolidation purposes. It might be easier to keep track of one account versus multiple. Maybe there's more investment options available in the new plan than the old one. Maybe the costs are less. Again, these are things you need to be considering before you make the decision to just arbitrarily do it or don't do it. The fourth thing that really needs to be focused on is really service. And what I mean by that is some people have no problem investing funds their own way. They prefer to do it. They like a hands-on approach. Other people maybe are looking for a bit more guidance. They want to have access to people that are knowledgeable about these things. And that's really where the service piece comes into play. If you keep your account in the current plan, more often than not, it means that you're going to be calling into an 800 number to get whatever it is taken care of, changing your investments, asking questions about the options, taking distributions, loans, whatever the case may be. Conversely, if you roll it over to, let's say, an advisory firm, then you're going to have access more than likely to a person or a team of people that are helping you and are readily available, who know your situation. You also have the option of doing it yourself and rolling it to a brokerage account. That would be more similar to keeping in the plan, only you have more control. But in both those situations, you're still going to be calling into an 800 number if you need a certain level of work or service done for you. Conversely, if you're working with an advisory firm, it's going to be more readily available and you're going to know the people you're talking to. Really, the choice is yours. It depends on what level of service and guidance you're specifically looking for. So a fifth option that I would not recommend unless there really is no other option is cashing out. So this is where you're essentially saying, I need the money. I know that there's going to be taxes. There's going to be penalties. I just need access to it for whatever the case may be. Now, as I already just said, you're going to need to be aware of the fact that if you're under 59 and a half years old, not only are you going to pay taxes potentially on the total amount you distribute, whether it's Roth or pre-tax, but you're also going to be paying a 10% penalty on top of that. So in majority of cases, I would never recommend somebody completely cash out their employer-sponsored retirement plan, right? Or the account that they have there. But In certain circumstances, it's just beyond your control. You need access to the funds. You can use them, just understand there's going to be more than likely taxes and penalties owed on that. A sixth thing to consider is, are you invested in a pre-tax retirement account or are you in a post-tax or Roth account? Now, that's obviously a big difference because most people understand traditional 401ks, you're getting a deduction off the contributions you make. So that's what we would call pre-tax. It has not been taxed yet, but when you take distributions from those types of accounts, then you're taxed. A Roth account, on the other hand, is the opposite of traditional in that you're not getting the deduction off contributions you're making to the plan. Okay, so this is post-tax. The taxes have already been paid. They still are growing tax deferred, similar to traditional, only when you start drawing them during retirement, you are not paying taxes on that either. Essentially, the way that this differs is with traditional, you're paying tax on the growth, whereas with Roth, you're paying a tax on the seed. And this comes down to personal preference, but you have to ask yourself, do I want to get taxed on the seed or on the crop? It's up to you. An important distinction, though, is understanding the differences between a Roth versus post-tax. There are employer-sponsored plans, and I won't get into too much detail here, but there are employer-sponsored plans where the money is going into a post-tax account, but it is not a Roth. What are the differences? Well, one of the differences is that with a post-tax account, when the money is rolled over later, you're not taxed on the contributions, but the earnings are considered pre-tax, and those are going to be taxed at the income level. So that's an important distinction. Another distinction is Roth 401ks or Roth accounts do have limitations in terms of how much you can put in, whereas post-tax accounts do not. Another important rule is the 5-year rule. This pertains to Roths in particular. I won't get into too much depth and detail on that, but the gist is if you're going to put money into a Roth account, you need to be prepared to hold it for at least 5 years in most cases without taking a distribution. Otherwise, you may be subject to taxes. And the last thing you need to really consider is what's called NUA or net unrealized appreciation. This is a very special portion of the tax code that allows for people who have large amounts or really almost any amount of employer stock in a 401k to lower their tax bill. So how does this work? The way that it typically works is, let's say you have a certain amount of company stock in your 401k that you either were gifted or purchased over your years working with the employer. And let's say that, for example, it's $200,000 worth. What the IRS allows for you to do, if you go through the right steps of this procedure, is you will pay income taxes on the cost basis of the stock, but then you will only owe capital gains on the growth whenever that's sold. So the reason why this is important is, in most cases, when you start drawing money out of pre-tax retirement accounts, it's all taxable as income. And in case you're not aware, income taxes typically are some of the most highest in this country, and they almost always are going to be higher than capital gains. However, by utilizing the NUA strategy, what you're able to do is lower your tax bill, and here's how you do it. Let's say you have $500,000 in a retirement plan, okay? And $300,000 of it is in company stock, for example. Now, let's say that the cost basis on that $300,000 worth of employer stock is $100,000. So you have a cost basis of $100,000. You have a total value of employer stock of $300,000. What you would do is that by utilizing a brokerage account, you could move the employer stock over. You would pay income taxes just on the cost basis, so just on the $100,000. And then whenever the stock is sold, you would pay capital gains taxes on the $200,000 worth of growth. And so let's say, for argument's sake, you're in the highest tax bracket. Right now, that's 37% in 2024. Under normal circumstances, if you did nothing like what we're talking about, you would pay 37% in taxes on any amount you distribute from company stock or your own contributions or other investments in the 401k. If you utilize, though, the NUA strategy, you'd pay 37% on the cost basis of $100,000, but the $200,000 would be subject to capital gains taxes, which in most cases is 20% or 15%. So right there, you're saving potentially 15, 17% in taxes on $200,000 in a retirement account that to start with was only $500,000. So this is a major tax saving strategy. Thanks for your time. I appreciate you watching. Understand, I don't know your situation. Everyone's situation is different. This is not meant to be tax advice or investment advice. This is really just meant to give you some ideas to think about. Make sure you always talk to an investment or a tax professional before you make any decisions pertaining to these things, because they are big decisions. If you'd like to reach out to us, we'll be happy to help. You can reach us at Matt25Capital.com. As always, thanks so much and have a blessed day.